Happy holidays, dun da da da. Required minimum distributions are due on December 31st. That means the IRS wants theirs. I'm gonna show you how to calculate it. Hey everyone, welcome back to your classroom. I'm Thatcher Taylor, I'm the owner of ProPath Financial. I'm talking to all my clients that fit the proper age range that they gotta be taking required minimum distributions by year end. So I'm gonna show you the calculation. Let's say you have in total tax deferred balances of $2 million. You've done a good job, you worked hard, you saved. Then let's say you are married and your spouse is not younger than you by more than 10 years. I'll show you why that matters in a second. So let's say you're 73, your spouse is not younger than you by more than 10 years. So that puts your divisor at 26.5. If these numbers are the numbers that fit your particular situation, you will have an RMD of $75,471 and let's say 70 cents. That's a good chunk of change that you got to pay taxes on. And right now, assumingly you don't have any other strategies in place, this amount of money goes on your tax return as income. Before we start breaking this down even further, I just want to say thank you to everyone for their support on this channel. We're growing like crazy. Please make sure to like and subscribe and go down below and ask any questions that you have about this topic. So let's continue. You can see how quick this all can be. There are other elements that come into play when you look at these two very simple numbers that can make this calculation more complex. So first, let's talk about the $2 million. The $2 million is the total of your tax deferred dollars. So let's first start and let's just say you have all IRAs, and let's just say for some reason you have IRAs at different firms. So there's IRA 1, 2, and 3 at different firms. These need to be under IRS rules added together. So they're viewed all as one big pot of money. But that's $75,000, $75,471 that needs to be taken out. It can come either from all of them at once, or it can come as a portion of all of these. So it doesn't have to come from one or the other or individually be calculated. The IRS views it all as one big pot of money. But where this gets complex is, what if you have a 401k? And let's say you have $1 million in an old 401k that for whatever reason you left the money there, which in a lot of cases is just fine. This cannot be aggregated. This has to be divided by 26.5 and has to have that amount of money come directly from that account. So that amount of money is $37,785.85. So that's the amount that will have to come out of your 401k. The remainder, the other half of this, can again come from one or from multiple to meet the proper rules that the IRS sets for distributions as required minimum distributions. So the second number is the divisor. That's the 26.5 that I showed you above. That as well is set by the IRS. And they use 3 actuarial tables to help calculate these RMDs, but you need to fit your situation into the 3 tables. So there's table 1, there's table 2, and there's table 3. So I'm gonna show you all 3 of these tables now. Table 1, as you can see here, is the single life expectancy table for individuals and inherited IRAs. A lot of people do not fit into this table. Very rarely do we see it, but you need to understand that if you're inheriting IRAs, or your family will be inheriting IRAs, or you're single, this is the table that you will use to calculate your RMD. Table 2 is the joint and last survivor table for use by owners whose spouses are more than 10 years younger. This is what I was talking about before. If you have a spouse that's younger than you by more than 10 years, this is the table that you're gonna use. Table 3 is the uniform lifetime table. This is the table that the majority of people are gonna use, that your spouse is gonna use if they're not more than 10 years younger than you. This is the table that's gonna be most common. This is the table, as you can see here, where I got 26.5 if you were age 73 this year. So to end, we're going to talk about when the RMD has to be taken and some strategies to help reduce required minimum distribution. So your RMD has to be taken by December 31st. If you don't, you're going to have heavy penalties. Every once in a while they're lenient, but you got to take that RMD by December 31st, unless it is your first RMD and they allow you to go till April 1st of next year. But here's the problem with that. Now you have 2 RMDs. You got to take this year's RMD by April 1st, and you have next year's RMD as well. So if you have $75,000, that could be putting a ton of money on your tax return in any given year. Because remember, the distribution is based on the year. It's not going to work retroactively. So maybe consider just getting your RMD done this year. So here are 3 strategies to help lower your RMDs. First are qualified distributions. If you're planning for RMDs, you're not quite at the age, you can start to distribute money for regular living expenses and use it, which will reduce your required minimum distributions that are coming here in the future. So just taking money out of the IRAs or the 401ks will help reduce those RMDs, but you got to pay taxes, so plan accordingly. Number 2 are Roth conversions, being able to move money out of your IRAs and 401ks from a pre-tax state, pay the taxes now, and put it into the Roth IRA, which no longer has and will not have required minimum distributions. So it's just another tactic of being able to reduce down your pre-tax accounts so your first number on top of the calculation is smaller, so you don't have to take out as much in your RMDs. And then number 3, and my favorite, are qualified charitable distributions. If you are charitably inclined, you have charities or 501c3 organizations that you really, really feel passionate about, you can pull up to $100,000 out of your IRAs, give that directly to the 501c3 charity of your choice, and there's a very specific process you need to follow, and that will reduce down your IRAs, and that money could be used in lieu of the required minimum distribution. So let's say you had a $75,000 required minimum distribution and you don't need the money and you're very charitably inclined. You could take that $75,000, use the proper process from your custodian, give the money to 501c3, that distribution will not go on your tax return as income. Qualified charitable distributions are phenomenal. They actually start at age 70 and a half. And you can do up to $100,000 in any given year as a qualified charitable distribution. That's a really cool tactic. All 3 of these tactics could be utilized to help reduce future required minimum distributions. If you need help with things like this, please don't hesitate to reach out to me below. My email, and there's a get started link where you fill out a quick form and I reach out to you directly and we schedule a meeting to talk about your retirement planning. This is what I do, is I help pre-retirees and retirees plan and navigate retirement in the most tax efficient way. Let me know if you have any questions. Thanks for watching. Please like and subscribe. We'll see you next time.